Let's look at some introductory level questions related to our chapter on merchandising. First question up here is a true or false question, and it says the operating cycle for a merchandiser is more complicated than that of a service business. This is absolutely a true statement. Service businesses, they will provide a service and then they'll either get paid or on the spot, or they'll set up an accounts receivable. Because a merchandiser has inventory, they're more likely to have, they have to account for that inventory. They may have accounts payable that they set up. Usually when we buy inventory, we don't pay cash for it. Sometimes we do, but not often. So if you recall from the PowerPoint presentation, a merchandiser is between a 5 and 6 step process, service business 2 to 3 steps. All right, next question says, which of the following accounts will only be found in the chart of accounts of a merchandising company? And so we look at these and we say, well, you know what? I know that accounts receivable are for all types of businesses, and accounts payable are also for all types of businesses. Because even if we're a service-related business, we could have accounts payable. It wouldn't be inventory, but we could certainly have accounts payable. So B and D don't look very good. A and C actually look to be both correct answers. Probably the best answer here is C, and I say that based on the idea that there are a lot of different, when we talk about sales and revenue and fees earned, those terms are so interchangeable. I don't really know that it matters which one of those we pick. I don't necessarily have a problem with calling service revenue, calling it service revenue, or calling sales revenue. So if we were just going to look at this from the perspective of a service-related business and comparing that to a merchandiser, and there are other types of businesses out there, the most obvious answer would probably be C. If you're leaning towards A, though, I can't completely fault you on that. All right, let's look at the third question, and it says, when the perpetual inventory system is used, the inventory sold is debited to what? Okay, so perpetual inventory, when we sell that inventory at the point of sale, okay, what is the other side? We know that, we should know that what's happening to inventory. Inventory is going down. Inventory is an asset, so inventory, which is choice C, should actually be a credit. It's asking us what is debited, so we need to debit some type of an expense. Well, we're not inventory are not supplies, so A doesn't seem good, and sales are not an expense item in any way, so that leaves cost of goods sold, and that's going to be our answer. So if we were to think about this, our journal entry, and I'm going to abbreviate here, would be cost of goods sold. As our debit, inventory goes down, so we move it over to the right there, and that's going to be our credit. Okay, moving forward, next question says, which of the following is not a controlling account? Well, we have accounts payable, accounts receivable -C Baskin, and equipment. Okay, so think about this now. We can have accounts payable, and then we can break that down into all the different vendors that we owe. That makes accounts payable a controlling account, and the same is true for accounts receivable. The correct answer is going to be C, because when we say accounts receivable and then we specify that it is for a customer named C Baskin, well, this account is a subsidiary account of accounts receivable. Okay, So with our equipment account, we can actually break this down as well. So equipment can be or is a controlling account. We may actually see it, it's going to show up on the balance sheet probably just as one lump sum. But if we were to look at our actual accounting records, we would see that our equipment might be broken down into several different parts into subsidiary accounts. But equipment by itself is a controlling account. So again, the correct answer is C. Under the periodic inventory system, the journal entry to record the cost of goods sold at the point of sale will include which of the following? None of these: cost of goods sold, inventory, purchases. Now this looks an awful lot like this question right up here. But the difference is that this question asked us for what we would do under a perpetual inventory system, and this is our answer. A periodic inventory system, what do we do at the point of sale? Or let's see here. It says the journal entry to record the cost of goods sold at the point of sale will include which of the following? The answer is none of these. We're not going to do anything at the point of sale with regard to these choices here: cost of goods sold, inventory, or purchases. Okay. When we buy inventory under a periodic system, we're going to hit this account here called purchases, and then at the end of the year we're going to reconcile our inventory, and we're going to figure out based on the formula of beginning inventory plus purchases minus ending inventory, beginning inventory and ending inventory equals cost of goods sold. We can do that, but we're not going to do that at the point of sale. So none of these, which is choice A, is going to be the correct answer. Let's see if we can get this up here. We can see the last two questions. Okay, good. Says here, under the perpetual inventory system, all purchases of merchandise are debited to the account. What do you think? All purchases of merchandise are debited to the account. Well, we said that under periodic, they're going to be debited to purchases. So that's probably not going to be the right answer for a perpetual inventory system. It's going to be inventory, the most obvious thing. We're not going to debit cost of goods sold. We're not going to debit cost of goods sold until we actually sell that inventory. All right. Final question says, let's see here, the journal entry to record the receipt of inventory purchased for cash in a perpetual inventory system would be, well, we better, if we know the answer to this question, we can actually get this even if we don't look at both sides of the journal entry, because we said right up here, all purchases of merchandise are debited to inventory. And if we look at our choices here, we only have choice A with a debit to inventory. And of course, the second part is purchased for cash. So in this particular case, cash is going down, and we reduce assets with a credit. So that makes sense. And our answer is going to be A. All right, so that's it for this handout, and we'll get the next one up, the solutions for the next set of slides up next.